Starting with the new chapter of your income tax syllabus called as Black Money Act. This is a recent addition to your paper number 4 of direct taxation. Like I told you in the past, this was actually an addition which was from the international taxation open book which was there in your old syllabus, right? It was there as a part of your open book syllabus. It has now been moved to your actual main chapters itself. You have a fresh chapter called as Black Money Act. Now, while I may be using the word as Black Money Act, the actual name of the act is the Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. Yes, it's a very lengthy name. It's the Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015, a recent addition to your syllabus. Expect a question from this coming in exam this time, because in the recent RTP which got launched also there was a question. A very easy and a straightforward chapter, nothing complicated about it. I'll tell you 3 areas where you need to focus on. If you focus on those 3 areas alone, you will get questions around it, right? Only that much is able to focus, nothing beyond it. But before we get to that 3 areas also, let's first discuss this chapter properly. Let's read the first line once again. It says the Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. Reading by this itself, one thing which should hit your head is they are saying undisclosed foreign income and assets. They are saying undisclosed foreign income and assets, which means this act only applies in case you're talking about foreign income. It only applies in case of foreign income, meaning Rahul, you're doing some smuggling and all activities in India. Will this section apply? Answer is no. They will not apply. It will only apply in case of those incomes which are generating from a foreign country, meaning it should be a global level black money avoidance. Only in that case will this chapter apply. First important thing for you to know before even we start this chapter, right? Which means if you going forward see an income in exam, you need to ask yourself, Rahul, is the income coming from India or is the income coming from foreign? If the income is coming from India and it is a black money nature, you will go to that sections of 69. You'll go to the sections of 69, 68 and all those things where we discussed about unexplained income. You will go there and you will tax it there. Going forward, if you see any kind of incomes coming from a foreign source, you will come to the chapter called as Black Money Act. This is how even income tax has told it. Income tax has told if it's an Indian level black money, then it will be done under Income Tax Act. If it's a foreign level black money, it will be done under a foreign act. It will be done under Black Money Act. Clear with the background? Yes. Now, since we are starting a new act, it will start with the same style as how we did the old act. Let's start with the same style as how we did the old act. In Income Tax Act, how do we always start? We always start with something called as the mother section, which is nothing but the charging section. Let's read the charging section. It's a 3-line charging section. We will break it down one by one. Charging section is section number 3 under Black Money Act. It comes and says any undisclosed foreign income and asset of the previous year in respect of an assessee shall be taxable at the rate of 30%. So they're coming and saying if there is any kind of undisclosed foreign income and asset of an assessee in the previous year, it will be taxable at the rate of 30%. Now you will come and ask me, Rahul, in Income Tax Act, when it was an Indian income, you asked me 60%. Here you're asking me only 30%. Apo, it is better to do foreign black money. No. Why would government have this partiality? Why would they come and say that if you do it from Indian source, it is 60%, but there it is 30%? Understand, things will go complicated differently. There they came and said it is 60 plus 25 plus 4, effectively 78%, plus a 10% penalty. Which means 78 plus 10% is about 85.8% taxes. Correct? Here things go very ugly. Here they are coming and saying, Rahul, you will pay tax at the rate of 30%. Plus 300% penalty. How much? Plus 300% penalty. Now tell me, Rahul, which one will you prefer? You'll obviously prefer the Indian one. When we go to penalty, that time you'll understand, right? Right now, the Black Money Act comes and says whenever you have any undisclosed foreign income or asset, you will pay tax on it at the rate of 30%. You will pay tax on it at the rate of 30%. Background clear? Yes, yes. Now the question when then comes is, Rahul, you're saying undisclosed foreign income and asset of the previous year. Undisclosed foreign income and asset of the previous year. Now income I understand. Income I understand. Today I earned an income, it was undisclosed, therefore they put it up and they taxed it at 30%. They put it up and they taxed it at 30%. Hey, looking at an asset, I have a foreign asset. An undisclosed black money asset. I have not shown it anywhere. Imagine the asset is 50 years old. Today only assessing officer put a raid on me and he found out all these things. Today only he put a raid and he found out all these things. Do you think he'll go back 50 years and collect taxes? Obviously no. Because see, understand, for an income is a different story, because income is of current year. But when it comes to asset is not of current year. It was identified in the current year. Agreed, not agreed? Agreed. In that case, the charging section coming and saying that the undisclosed asset of the previous year shall be taxable in 30%. Does it make sense? No. That is why this section also has a proviso. Let's read the proviso carefully. The proviso comes and says, if it is an undisclosed asset, which is located outside India, this will be taxable in the previous year in which the asset comes to the notice of the AO. It shall be taxable in the previous year in which it comes to the notice of the AO. So they are coming and saying, Rahul, when it comes to an income will be taxable in the previous year in which it is relating to. But when it comes to an asset, it is taxable in the year in which it comes to the attention of the assessing officer, so that we are able to ensure that all taxes are paid. Is the charging section clear? Yes. Let's now break down the charging section. I saw some 1, 2, 3, 4 words. Let's start with the easiest one. The easiest one being assessee. The first important thing from exam perspective. Rahul, when it comes to black money, who do you think is an assessee? Ask yourself a question. This act is applicable on foreign income or Indian income? This act is applicable on foreign income or Indian income? It is applicable on foreign income, meaning income earned from outside India. Correct. Now imagine a scenario. There is a person sitting in foreign country earning income from foreign country. India will collect taxes, correct? India will collect taxes? No. Obviously, it is talking about those people who are sitting in India and collecting income from foreign country. Yes or no? Which means this section should only apply to a resident. Very good. Income tax came and said, Rahul, who is an assessee under Black Money Act? Under Black Money Act, an assessee only means a resident. Under Black Money Act, an assessee only means a resident. Now, resident obviously is already defined under Income Tax Act, so they came and said, you take the same person. Correct, not correct? Correct. Now, imagine a scenario where what has happened is Rahul is a resident, and I have bought some assets. In foreign country, all black money. After that, I left off India and went away. I never came back. I automatically became a non-resident. 5 years later, I came back for a one-day trip. Suma, for some reason, I was called to India. I came for a one-day trip. On that one day, assessing officer suddenly caught me on the flight, and he hand-holded me. He came and said, dear Rahul, I was waiting for you for 5 years for you to come to India. Today is the day when I have caught you. You have some black money assets in outside India. Pay me taxes. I came and said, dear assessing officer, while I do accept the fact that I have some black money assets, I will not pay you a single rupee tax. He says, why will you not pay? I said, sir, understand, today when you caught me, I am under income tax. I am under income tax a non-resident. And if I am a non-resident, I do not fall into the definition of assessee for Black Money Act. Agreed. Agreed. Now, Rahul, if I'm not going to fall under the definition of assessee for Black Money Act, can he tax me? Can he tax me? Can he tax me? No, he cannot tax me. Yes or no? Now, because he cannot tax me, have I avoided taxes? Not avoided taxes. I have avoided taxes. But technically think about it. When the asset was bought, I was a resident, which means in all practical sense, when I bought the asset, I was a resident, meaning the money which I would have used would have been Indian money. When I was doing all illegal activities, I was an Indian person. So I should also be covered. Agreed. This is what your exam question is. The second part of assessee definition. They came and said, Rahul, assessee means a resident in India. No problem. Assessee means a resident in India, but it also includes a non-resident. Which at the time of buying the asset or at the time of generating the income was a resident. Second definition of assessee, it comes and says any kind of non-resident or an RNOR, which as per section 6 of Income Tax Act was a resident in the previous year in which the undisclosed foreign income relates to, or the undisclosed asset located outside India was acquired, or the undisclosed asset which is located outside India was acquired. Expect a question around this in exam where they will come and say, Rahul, there is a person who bought assets in 2011 and 12 where he was a resident. In 23-24, when he came to India, that time he was caught and was asked to pay taxes. The person decided and he said that I am a non-resident in current year, therefore I will not pay taxes. Discuss and confirm whether the contention of the assessee is valid. You will say not valid. Because the year in which he purchased the asset, that year he was a resident and therefore the provisions will apply to him. Clear? Yes, this is the definition of assessee. Second definition is previous year. Now, I'm not going to tell you what is a previous year. Previous year is the same as Income Tax Act, meaning April to March. But imagine the business has started in the current year only. Starting date will be the date of setup. The ending date will be 31st March. Rahul, the business is discontinued in the current year. Start date will be 1st April. End date will be date of discontinuance. That is something which you'll already know. I don't have to elaborate it much further to you. Yes. So what is the previous year? Previous year for a newly set up business is date of setting up and will close on the 31st March. However, if the business is going to shut down, then the closing date will be the closure. If there is a discontinuance, then it will start on 1st April and will end on the date of discontinuance. And if it is any other case, then it's a general case which is April to March. Clear? What have we completed in the charging section? We have completed what do you mean by an assessee? Assessee means a resident in India, and it also includes a non-resident in India provided the asset or the income pertains to the year in which he was a resident. Point number 1. Second, what do you mean by a previous year, Rahul? Previous year is normally April to March, excluding, yes, if you have started in the current year, then the date on which you started. If you exited in the current year, then the date on which you exited. Now coming to the important definitions. What is undisclosed foreign income and asset? What is undisclosed foreign income and asset? The act comes and says an undisclosed asset outside India means an asset located outside India which is held by the assessee in his name, or in respect of which he is a beneficial owner. You would have seen the same wordings in return filing chapter, if you recall. Yes, in return filing chapter, if you recall, we came and said generally mandatory filing of return has to be done by an ROR. Who has the asset located outside India, or is a beneficial owner of an asset located outside India, or as a signing authority. Yes, that is what they've copy pasted here, because when we were discussing that time itself, we came and spoke about this fact that income tax is giving you an opportunity to disclose all your assets and belongingness and dealings outside India, so that they can come and check whether it's all happening properly, or is there any black money to it. Is there any black money to it? So they're coming and saying an asset including a financial interest in an entity located outside India, which is held by the assessee in his name, or in respect of which he is a beneficial owner, and he has not given any explanation about the source of investment in such asset, or the explanation which is given by him is unsatisfactory in the opinion of the AO. Unsatisfactory in the opinion of the AO. We have learned the same line somewhere. We have learned the same line somewhere, which is in the chapter called as unexplained income. Yes, in unexplained income, I gave you a short summary, right? In the summary, we came and spoke about the fact that in exam, whenever you see the word unexplained, you have to just come and say unexplained, meaning something which is not explained or something which is explained but is not satisfactory, directly tax it at 78%. Same thing they've given here. Same thing they've given here. They just come and told that the asset should be located outside India and the source is not available, or the available source is given but not explicitly satisfied. Explicitly satisfied. Clear? Yes. Now, Rahul, what is an undisclosed foreign income and asset? What is an undisclosed foreign income and asset? Black Money Act comes and says undisclosed foreign asset and income for any assessment year would be an income from a source which is located outside India and has not been disclosed in the return of income, and has not been disclosed in the return of income which is filed under Income Tax Act. Which means, first line I'm coming and saying you have an income from a source outside India but you have not shown it to me under Income Tax Act. That is a black money. That is a black money. Second, income from a source located outside India in respect of which a return is required to be filed but no return has been filed. But no return has been filed. Which means scenario number 1, I'm coming and saying, Rahul, you have filed a return but you have failed to disclose this income. Scenario number 2, I'm coming and saying, Rahul, this income you should have disclosed but return itself you have not filed. Return itself you have not filed. And third one is value of any undisclosed asset located outside India. Value of any undisclosed asset located outside India. The first two were incomes, the last one is an asset. Meaning they are coming and saying you have made an investment somewhere but the source is not there. The source is not there, or the source which you have told me is not satisfactory to me. That value. Now obviously when you say that value means what value? Yes, you need to know the value. You need to know the value, which is the next thing which is most important from exam perspective. The next thing which is most important from exam perspective. How do you decide what do you mean by a value when it comes to asset? How do you mean? What do you decide as a value when it comes to an asset? I'll give you a small hint. This section is almost similar to your chapter of exit tax. This section is almost similar to your chapter of exit tax. Exit tax, where did we discuss? We discussed it in the chapter called as charitable organization. Yes, charitable organization ka aprom we said if the charitable organization is going to violate any conditions, then the price at which it is going to be sold today or the fair market value and all, we'll take it as whichever is higher. Same concept. Read it one by one. You'll see the same concept. You'll see it same. First one, Rahul, if the asset is a jewelry, archaeological collection, drawings, paintings, sculptures, or any other work of art, the act is coming and saying in that case the value of this would be the actual cost of acquisition or the price it would have fetched if it is sold in the open market basis valuation report, whichever is higher. If you itself are coming and telling me that this is what you have paid it for, and I am coming and checking the open market, whichever is showing a higher price, that will become your undisclosed asset, and on that you have to pay 30% tax. Clear? Yes. Second one, Rahul, if it is not a jewelry, archaeological collections and all, it is a simple share and securities. Black Money Act comes and says, tell me whether the share and security is a quoted share or an unquoted share. If it is a quoted share, we would have discussed quoted shares you have to do. Average. You have to do average meaning opening price plus closing price. So they are coming and saying, Rahul, take the average price on the date on which it was acquired. On the date on which it was acquired, compare it with the actual cost of acquisition, whichever is higher. Whichever is higher. However, Rahul, on that date, if trading did not happen, on that date, if the trading did not happen, you will take the price on the previous trading date. You will take the price on the previous trading date. Yes or no? Yes, yes, yes. Next, point number 3. Unquoted equity shares. Unquoted equity shares. Now we discussed, no, when it comes to unquoted equity shares, you have to find out the net worth of the business. Yes or no? Yes. How do you find the net worth of the business? Rahul, you do assets minus liabilities. You do assets minus liabilities, but assets also will break up. Assets also will have breakup. Assets also you have to come and understand which type of asset are you talking about. So they came and said, Rahul, when it is a immobile property or specified mobile property, you'll do the same valuation as what we did above. You'll do the same valuation as what we did above. But if it is not a specified mobile and immobile property, other assets you'll take at book value. Other assets you'll take at book value. In that assets of book value, you will not consider any kind of income tax payments. You will not consider any kind of income tax payments like advance tax, self-assessment and all those things. Don't consider those, and don't consider any unamortized portion of deferred revenue expenditures. Unamortized portion of deferred revenue expenditures. If you recall, we did the same thing in exit tax, and we have done this multiple times whenever we discussed about fair market values. Yes or no? Yes, every time we spoke about fair market value and everything, we discussed about it. Whenever you talk about an asset, always take the book value, but ignore any kind of income tax payments and ignore any kind of deferred expenditures, any kind of deferred expenditures. This is on the asset side. On the liability side, what will you do? You'll take everything at book value, but you will reduce any kind of share capital, any kind of reserve and surplus, any kind of proposed dividend, any kind of provision for tax, any kind of unascertained liabilities, or any kind of contingent liabilities, We did the same thing. Yes. Now, Rahul, with this asset minus liability, you will get net worth of the business. You'll get the net worth of the business. You'll divide it by the number of shares. No, you want value per share. So you divide it by the number of shares. This number will be compared with the actual cost of acquisition, whichever is higher. Agreed, not agreed? Agreed? Yes. Rahul, what if it's not an unquoted equity share? What if it's an unquoted debenture and all those things? In that case, again, you'll go back to the first scenario, which means you'll do actual cost of acquisition or the price it would fetch in the open market basis a valuation report, whichever is higher. The change which comes is for immobile property. In stamp duty value and all, if you recall, it was stamp duty, in exit tax and all we discussed, we normally used to speak stamp duty value. Here, for immobile property, first time they are coming and saying, don't take the stamp duty value, but again get a valuation report. So even for an immobile property, it is actual cost of acquisition or the price that it would fetch in the open market basis a valuation report. In exam, if they give you the stamp duty value, you will ignore it. That's a miscellaneous information given to you and not relevant for your computation. Clear, not clear? Clear? Yes. Final few items. Rahul, if it is a bank account, if the asset which you have outside India is a bank account, Black Money Act comes and says, Rahul, in bank account, it is not closing balance, it is not opening balance. I want the whole dealings in the bank account. Because the whole bank account itself is undisclosed. Yes or no? Yes. So every dealing which is happening in the bank account, I want all the transaction details. Every transaction is an undisclosed income. Correct, not correct? Correct. So they're coming and saying, Rahul, if you have a bank account which is undisclosed to me, then every deposits which you have in this bank account, I want details of all the deposits, because all the deposits are going to become undisclosed income. Clear, not clear? Clear? Yes. Now, Rahul, what if I've made a withdrawals? They'll say ignore it off because expense anyway cannot be claimed. But if it can be proved that the withdrawal is from the deposit, meaning you're going to withdraw money and then again deposit it. If you're going to withdraw money and again deposit it, in that case, will the deposit be taxable? Will the deposit be taxable? No. In exam, if you get a question where they come and say, Rahul, there are 500 deposits made. Out of that 500 deposits, 200 deposits, there are withdrawals, and that same 200 amount has been again deposited, you will come and say, then in that case, those deposits will not be taxable. The balance 300 alone will be taxable. The balance 300 alone will be taxable. Clear? Clear? Yes, but there is an exception to this rule. The exception to the rule says, in case a declaration has been submitted by the assessee, disclosing the undisclosed assets and tax along with penalty, then the amount so already taxed shall be excluded. Meaning they're coming and saying, out of this bank account, if you had purchased another asset and on that asset you have paid taxes already, in that case you can go and inform the assessing officer that here the money which I got, based on that I have already bought an asset, and on that asset I have already paid taxes to you. Here is my declaration. If that happens, then that dealing deposit will be excluded. Common sense? Yes. Next few items. Interest in a firm AOP or BOI. Meaning you have an interest in a firm AOP or BOI which is located outside India, but you have not disclosed this to us. You will again do the net worth. So they're coming and saying, net assets of the firm AOP or BOI, which is computed as above and is allocated to the partner and member as follows. The capital contribution given by him, plus residuary assets, if any, allocated in profit sharing ratio. In simple words, we're talking about the closing balance of the capital account. Including the reserve and surplus. Yes or no? Yes. Point number F. If it's a general asset, if it's no other assets which are covered above, again they're coming and saying, take the actual cost or the price which would fetch in the open market based on an arm's length transaction. And if it is any other asset, which is not in the possession of the assessee right now, which means, imagine an example where what has happened is, in the current year, 5 years later, I have got caught. Today, what is happening is, assessing officer caught me and came and said, you know what, 5 years later itself, I found out that you have done these dealings. You have these assets outside India. I want you to pay tax at 30% on it today. Tax at the rate of 30% on it today. If you remember the black money charging section, we came and said it will become taxable in the year in which it is noticed. When is it noticed? Current year. Correct. And the provisions are here coming and saying it should be the price at which it will fetch in the open market in the 1st April of this previous year. Now what happened is, assessing officer came and said, yes, I want to tax it for you. So I'm looking at the previous year order open market value. I came and said, sir, you cannot do that because asset is not even there in my hand. In this last 5 years itself, I have sold off the asset, sir. Question to you, will the asset still be taxable? Yes, obviously, because see, at the end of the day, it was an undisclosed income and an undisclosed asset. It does not mean that just because you have sold it off, the asset will not be taxable. Hello? Yes or no? Yes. Therefore, for that also valuation guidelines are given. They're coming and saying, Rahul, if you have an asset which is sold before the previous year itself, then in that case, it is the actual cost of acquisition or the sale price, meaning the price at which you had sold it in the open market, you take that price, whichever is higher, because that is the profit which you made. So the price at which you are purchased it or the price at which you sold it, whichever is higher, will become the price at which I am going to tax it for you. Yes. However, if it is found out that the price at which you transferred it was inadequate, you purposely transfer it at a lower price, then Black Money Act comes and says, I will ignore the sale consideration and I will consider the fair market value on the date of transfer. fair market value on the date of transfer, meaning if the asset is transferred before the April previous year and it was sold for an inadequate consideration, the price at now it will be cost of acquisition or the FMV on the date of transfer, whichever is higher. FMV on the rate of transfer, whichever is higher. Simple words, I can come and say it is actual cost or sale price or FMV, whichever is higher. It is actual cost or sale price or FMV, whichever is higher. Whichever is higher. Agreed? Agreed. Yes. Final thing, which is the important thing for exam. The final item, which is the important thing for exam. We are looking at asset acquired from the consideration of an old asset or withdrawal from a bank. Asset acquired either from a withdrawal of a bank or from an old consideration. Like I told you recently, if you're already going to tax bank account, if you're already going to tax the bank account, the asset which you have acquired from the bank account, if you will not if you decide to tax that first, then you can go to the bank account and come and say, sir, I don't want to tax it. This is what we're discussing. Imagine an example where what has happened is you have had an asset of 10 lakhs. You sold this asset for 20 lakhs. Black Money Act comes and says take 10 lakhs or 20 lakhs, whichever is higher. So pay tax on 20 lakhs. Now this 20 lakhs, what will you do? Will you always keep it in your pocket? Answer is no. What will you do? You'll take this 20 lakhs and put it in another asset. Yes or no? Yes. So you decided that you took this 20 lakhs and you purchased another asset. Now, Black Money Act comes and says, Rahul, you have to tax the first asset. They also say you have to tax the second asset because second asset is also from undisclosed income only. Yes. Here is where Black Money Act comes and says, Rahul, you will not tax it double. I'll give you a mechanism to tax. Rather than reading the mechanism, let's read the example. See if you understand the example properly. Example says, a house A is located in country outside India, was brought for 1995 at the price of 15 lakhs. You have a house outside India, undisclosed, bought in 1995 for 15 lakh rupees. It was sold in 2000 rupees it was sold in year 2000 for 22 lakh rupees. Question to you. This is going to be identified by you today. Today you have the asset, yes or no? Today do you have the asset? No. You don't have the asset. If you don't have the asset, Black Money Act comes and says you will do actual cost or sale price, whichever is higher. Now how much is that? 15 or 22, whichever is higher. Therefore my black money becomes 22. Now come next. This amount was deposited in a bank account in that country. Hey, when you have deposited this money when you have deposited this 22 lakhs in the bank account, today this bank account has the money, does not have the money. It has the money, which means if you take the asset and you take the bank also, what will happen? It will become. So therefore they came and said, you do one thing, you ignore the asset. You take as if this money is deposited in a bank account, and therefore you will say asset is no more taxable. Because this 22 lakhs is already there in the bank account. So what they came and said is, Rahul, the black money for the purpose of the first asset, will be higher of 15 lakhs and 22 lakhs, which is 22 lakhs minus 22 lakhs, because that is the amount which you have put in the bank account. Minus 22 lakhs being the amount which you have put in the bank account. Yes or no? Yes. Change the example. If the question would have come and said that the sale price is 22 lakhs and out of the 22 lakhs you have only transferred 10 lakhs to the bank account. In that case you will come and say, sir, then the bank account only has 10 lakh rupees. You have not accounted for the balance 12 lakh rupees. So you tax the 12 lakh rupees in the hands of the house as a form of house. Balance 10 lakh is anyway there in the bank, so bank will take care of it. Correct, not correct? Correct. Can we proceed? Yes. Read next. In 2001, another house was purchased for 35 lakhs. The investment in the house is made through a withdrawal from the bank. Notice this line very carefully. In 2001, you decided to buy a second house. In that second house, how did you make the investment? The investment was made through from the bank, which means you should tax in the hands of the bank, or you should tax it as a form of asset. You should tax as a form of asset, because I told you, if the asset is going to be taxed, then the bank amount it will not be considered. Yes or no? Yes. Now notice the lines. It says the amount was deposited in a bank account in that country. In 2001, another house B was purchased for 35 lakhs. The investment in house B was made through the withdrawal from the bank. That is what we discussed. House B has not been transferred before the valuation day, and the valuation of such asset as on today is 48 lakhs. As on today's 48 lakhs. If the asset has not been transferred, valuation will be the actual cost price or the FMV on today, whichever is higher. Today the price is 48. That day the price was 35. Therefore it will become 48. Correct? Hello. Yes, it will become 48. So therefore my house B is going to be taxed at 48. Now they are coming and saying, Rahul, when it comes to the bank, the FMV of the bank today is 60 lakhs. Question to you. The FMV of 60 lakhs which you see right now, is all deposits together. Agreed? Hello? Is all deposits together? Yes, that is what we said. No, when it comes to bank, you have to consider all deposits. But what has happened? In the deposit, 35 lakhs has gone out in the form of house. And you have already taxed it in the form of house. Agreed, not agreed? So should you tax the 35 lakhs worth of asset? No. Therefore, they came and said, Rahul, when it comes to bank, you make it 60 lakhs, which is the taxable amount today, minus the 35 lakhs, which you have anyway going to tax in the hands of house B. Anyway, 35 lakhs you're going to tax as house B. Therefore, you will tax only 25 lakhs when it comes to bank. In simple words, Rahul, house A became zero. Because the whole money was put into the bank account. The bank became 60 minus 35, because 35 is a part of that 60 which you have used and taxed already in the hands of house B. When it comes to house B, since the house was still available, you did higher of both. Hey, hello, clear? Yes. This is what you need to know. Fairly chapters over. Few points for you to know. One is, no expenses or deduction shall be allowed against any income, meaning black money will be taxable at gross value, same as unexplained. Second, no losses can be set off against such income. Air convey pachton. Yes. Third question is, Rahul, when this asset you're talking about is a foreign asset, obviously investments would have happened in foreign currency. Income should also be in foreign currency. How do you convert it? They came and said the FMV of the foreign asset will be converted into Indian currency using the RBI reference rate. Until now, whenever we used to discuss, we always used to speak about SBI rate. First time we are going to RBI. They say take the RBI rate and do it. If the foreign currency is designated by RBI. If they are not designated by RBI, such currency will be converted using US dollars. Meaning that country currency will be converted to US dollars, and then US dollars will be converted using RBI rate. Fairly simple things. Point number 4, any income or asset which is taxed under this act would not be taxable under Income Tax Act. Meaning they have come and said, Rahul, if you are going to tax something under Black Money Act, it will become exempt under Income Tax Act. Same asset will not be taxed twice. Point number 5, any variation made during assessment under Income Tax Act to an income from a source outside India would not be included in the computation of undisclosed foreign income. If before this act come into picture, something was already taxed under Income Tax Act, or you identified something under Income Tax Act before even assessing officer could find it under Black Money Act, then in that case you will not tax it under Black Money Act, since you have already taxed it under Income Tax Act. 6. Similarly, any income which has already been assessed to tax under Income Tax Act shall be reduced for the purpose of finding out the undisclosed asset outside India. Where such asset is an immovable property, deduction in the previous year shall be the amount which bears the value of the asset as on 1st April of the financial year in which it comes to the notice of the AO, the same proportion as the asset foreign income bears to the total cost of the asset. So they are coming and saying, Rahul, if at all there is any asset, which is of earlier years, and it was already taxed under Income Tax Act, you will again not tax it under Black Money Act. But please do keep this in mind that it is not a blanket thing. If you have only done a part tax in Income Tax, Act, you'll do a proportionate tax in black money also. A simple example is as follows. A house property located in country outside India was acquired by Mr. A in previous year 2013 for 60 lakhs. You acquired a house for 60 lakhs in 1213. Out of that 60 lakhs, 35 lakhs came into the attention of AO in Income Tax Act and was already taxed in earlier years. Hey, this 35 lakhs which was already taxed earlier, will you tax it once again? No. But ask yourself a question. This 35 lakhs is a building. Today the worth is 35 lakhs only, or it's increased? It's increased. Yes, they're coming and saying, Rahul, such an undisclosed asset comes to the attention of the AO in 23-24 when the value of the property is 120 lakhs. Understand very carefully. When the original purchase was 60 lakhs, the value today is 120 lakhs. Out of the 60 lakhs, 35 is already taxed, which means what is the value of the 35 lakhs? How will you do it? You'll come and say, Rahul, if 60 lakhs has become 120 lakhs, how much will 35 lakhs become? It will become 70 lakhs. Yes, now you were supposed to tax 120 lakhs, but out of that 120 lakhs, you will not tax 70 lakhs. Therefore, you will tax only 50 lakhs. Clear? Yes. Next important thing. Please keep this in mind. Yes. So three things like I told you. One is who is an assessee? Second is what happens in case of acquisition happening from a bank account. Finally, what happens in case some item is already taxed under Income Tax Act? 3 items for you to know for your exams. Is that clear? Yes. Finally, just to close your chapter, what is your penalties? It says, Rahul, if there is any undisclosed foreign income and asset which is identified by AO, the penalty is 300% of the tax computed. You are already going to pay 30% tax. Adhikku mele 300% is 90%, which means overall becomes 120%. No, correct. Now think about it. Will you like to pay 85.8% tax or 120% tax? Yes, be careful. You like to pay nothing. Don't be an undisclosed person. Be a good person in India. Yes, don't pay anything. Next, failure to furnish income tax return by ROR holding assets outside India as a beneficial owner or beneficiary or having any income source outside India before the end of the relevant year. If you have such things and income tax return you fail to furnish, it will be 10 lakh rupees. Next, failure to furnish information relating to foreign assets in the income tax return. So first one was foreign assets outside India as beneficial owner. Second one is normally foreign assets. In any case, it will be 10 lakh rupees. No penalty under 42 or 43 shall be levied in respect of a bank account if the aggregate balance does not exceed 5 lakh rupees. So they're coming and saying if it is less than 5 lakh rupees, no penalty. If it is more than 5 lakh rupees, you will be levied a penalty of 10 lakh rupees. Yes. Yes, it is a part of your Schedule FA of ITR. Yes. It's not FA. I think it's TPSR, TFI something. Okay, I think it's something like that. It's schedule. There's a schedule where you have to mention about your foreign incomes and all those things, and then schedule itself you have to mention all your assets and all. So I think it comes as schedule TPSR or TFI, something like that. I don't remember the schedule number properly. It's not schedule FA. Schedule FA is that assets and liabilities, right? So that's schedule AL. Acha, maybe then it's FA only. I remember something as TFI, something will come. It's a big name. It's some hyphen L on Nadu Varam. There are two schedules like that. So you have to be careful about both the schedules. You have to fill that schedule. Basically, in that schedule, they'll ask you for the bank account details, your asset details of foreign and all. So you have to be careful about that. Okay. Yes, last two items. If there is a default in payment of tax arrears, then it is 100% of tax arrears. If you fail to answer any questions with the assessing officer is asking you, if you fail to sign any statement with assessing officer is asking you, if you fail to attend yourself or produce any books which assessing officer is asking you, you will be levied a penalty of 50,000 to 2 lakh rupees. 50,000 to 2 lakh rupees. Yes, this is one thing which will happen. This is one thing which will happen. Now, question, Rahul. Rahul, black money you're doing. Black money you are doing. Will you be only levied penalty? Will you be only levied penalty and they'll let you go? No, obviously you've done a black money and illegal things, which means they will also give you prosecution. They'll also give you prosecution. Comes in the next part. If there is any willful failure to furnish returns of income and foreign assets details, the prosecution is 6 months to 7 years. If there is a willful failure to furnish in returns any information about assets located outside India, again 6 months to 7 years. If there is a willful attempt to evade taxes, penalty or interest, it is 3 years to 10 years. If there is a willful attempt to evade taxes or penalty by any other person, it is 3 years to 10 years, meaning it is not just you, someone else is doing it on your behalf, then also it is 3 years to 10 years. Making any false statement in verification or delivering account of the statement which is knowingly false, 6 months to 7 years. Abating or inducing a person to make or deliver a false statement, 6 months to 7 years. Second and subsequent defaults, you will automatically get a 3 years to 10 years prosecution along with the 5 lakh to 1 crore worth of fine. 5 lakh to 1 crore worth of fine. Let's solve the black money questions and see where we stand on this chapter understanding. Question number 1. It says, Ravinder is an Indian citizen who has left India and settled in UK from 10th April 2016. Right? So there is a person who has been a part of India but has left India and has gone to UK in 2016. He had never left India previously since April 2008, which means 2008 to 2016 he was a part of India. They are just clarifying to you that 7 years he was in India. They're just clarifying to you that 7 years he was in India, which means all the 7 years he was a resident. He acquired a property worth 200 lakhs in the name in financial year 13-14. In financial year 13-14 at Malaysia. So when he was in India, in financial year 13-14, when he was a resident, he had acquired a property in Malaysia. The assessing officer came to know of this in March 2024 based on the investigation which was made by Enforcement Directorate in some other person's case. So someone else's case was going on and this guy had his bad luck. This case was also got caught up. The assessing officer, having recorded some concrete evidence against Ravinder, issued a notice under section 10 of the Black Money and Imposition of Tax Act 2015 on 27th March 2024. Mr. Ravinder's counsel contended that since Ravinder is not a resident in financial year 23-24, a notice under section 10 could not be issued to him. Is the issue of notice on Ravinder under section 10 tenable under the law? Example. Like I told, the first important thing for you to know is that when it comes to the definition of assessee, when it comes to Black Money Act, assessee means a resident. But assessee also means a non-resident which has acquired undisclosed assets in the year in which he was a resident. In our scenario, what is happening is Ravinder, although in the current year is a non-resident, has been a resident in the year in which he acquired the asset, which was financial year 13-14. And therefore, he will still be called as an assessee for the purpose of that asset. The notice which is issued by the assessing officer is perfectly valid. The notice which is issued by the assessing officer is perfectly valid and there will be no disputes around it. Yes. Question number 2. An apartment located in country X was bought in 1988 for 10 lakh rupees. Okay. It was sold in the year 2003 for 30 lakhs. So you have an asset which you have bought in for 10 lakh rupees and then sold it for 30 lakh rupees. This amount was deposited in a bank account in country X. Now, this is the same kind of illustration we did right now. What we came and said is, if you are going to have an asset which you acquired and then sell off the asset and then sell off the asset, the undisclosed income will be the sale price or the actual cost, whichever is higher. In our scenario, it is 10 lakhs versus 30 lakhs. Therefore, the number is 30 lakhs. However, since the amount has been deposited in the bank account, it will not be taxable anymore because it has become a part of the bank asset. It has become a part of the bank asset. Anyway, the dealing of the deposit in bank will take care of it. The dealing of the deposit in bank will take care of it, and therefore this asset will become non-taxable. This asset will become non-taxable. Clear? Let's proceed forward. The amount was deposited in a bank account in country X. In year 2004, another apartment was purchased for 45 lakhs. Another apartment was purchased for 45 lakhs. The investment in the new apartment was made through the withdrawal from the bank account in country X. Like I said, it has been done from the country X withdrawal. 45 lakhs which you purchased. In that 45 lakhs, you put 45 lakhs from the bank. The new apartment has not been transferred before the valuation date, and the valuation date, the price is 55 lakhs, which means in the asset which is not transferred, it is the actual cost or the FMB on today, whichever is higher. In our case, it is 55 versus 45, therefore it is 55. But because you have made this investment using the bank account, you have made the asset using the bank account, for the purpose of bank account valuation, this will not be taxable. This will not be taxable. Let's come to the bank account part. They're coming and saying, assuming that the value of the foreign bank account is 70 lakhs, what would be the value of the new apartment? What would be the value of the new apartment? Now, bank account will be 70 lakhs minus the 45 lakhs. Minus the 45 lakhs. Why, Rahul, 45 lakhs? Because this 45 lakhs was withdrawn from the bank account and put into the asset, which is anyway getting taxed at 55 lakhs. Anyway, getting taxed at 55 lakhs. In simple words, Rahul, what will be the valuation? The valuation will be as follows. The original house, no tax. Bank account will be taxable for 70 minus 45. 70 minus 45. For the house, it will be 55 lakhs fully. For the house, it will be 55 lakhs fully. Why, Rahul? Because this 55 lakhs already comprises of the 45 lakhs. Therefore, I should not tax this 45 twice. And therefore, from the 70, I am removing 45. From the 70, I am removing 45. Clear? Question number 3. Mr. Pillu, aged 72, was the managing director of Ashok Private Limited at Surat. He retired in June 2009 and left India permanently in Jan 2012. So he retired in 2009 and left India permanently in Jan 2012, which means after Jan 2012, he is a non-resident. It came to the notice of JDIT investigation in June 2023 that Mr. Pillu had assets accumulated during the previous year 8-9 exceeding 500 lakhs outside India. Now 8-9 was the year in which he was in India because he was retiring that year. So he is a person of an assessee. He is a person of an assessee, which were not disclosed for income tax purposes up to 12/13, for which return of income was filed in India. So 12/13 variko he filed returns in India, but till that date also he did not disclose his assets. Mr. Pillu was served a notice under the Black Money Act and Imposition of Tax Act in August 2023. Mr. Pillu is of the opinion that since 10 years have lapsed from the last year in which he was assessed in India, no proceedings could be initiated under him under the Income Tax Act and the Black Money Act, since Mr. Pillu is also a non-resident for the assessment year 24-25. Discuss the liability of Mr. Pillu under the black money law and state the procedure and methodology for determination of the value of the asset outside India after evaluating the validity of the contentions. Pillu is coming and saying, sir, the assets which you are talking about was acquired in 2008-9. Today is 2024. Today you cannot come and ask me for 10 years old cases and all. I will not consider. Here is where the definition charging section comes into picture. If you recall the charging section, it comes and says that the undisclosed asset will be taxable in the previous year in which it comes to the notice of the assessee. In this case, since it came to the notice of the assessee in the year 2020, it came to the notice of the assessee in the year 2023. Therefore, it will continue to be taxable in this previous year, and therefore the contentions of Mr. Pillu is invalid. The contents of Mr. Pillu is invalid. Furthermore, since Mr. Pillu was a resident in that respective year, then the asset also becomes taxable for Mr. Pillu in India. The asset also becomes taxable for Mr. Pillu in India. Now, Rahul, what is the methodology? Because it is an asset which you have not sold, it will be the actual cost or the fair market value on the 1st April of current previous year, whichever is higher. Whichever is higher. That is what you would have seen in this whole thing. The combination of all the three sections have been given to you in a single shot. Last question, point number no, two more questions. So question number 4. Question number 4 comes and says, Deepak is aged 45, an Indian citizen, and has settled in California, USA since 2015. Prior to that, he has always been in India. He acquired a residential property in California in 2009. Understand, when did he leave? He left India in 2015. Before that, he acquired a house when he was in India in 2009, which means that house is going to make him an resident in India. That house is going to make him an assessee in India. For US dollars 20,000. He kept the bank deposit of 10,000 in a bank account in New York since 15th April 2010. So he acquired a residential house property in 2009 for 20,000 USDs and has kept a bank deposit of 10,000 in a bank account in New York since 2010. Notice under Black Money Act and Imposition of Act was issued on 20 October 2023. The fair market value of the residential property is 25,000 on 23 April, 32,000 on 24 April, and 30,000 on 20th October. It says provisions come and say it is actual cost of acquisition or 1st April of the previous year in which the asset was noticed. When the notice was issued, it was 2023. It was 2023 October, and therefore it will be 1st April of the previous year, which means in our scenario it will be $25,000. It will be $25,000. The bank deposit with accrued interest thereon was 12,500 on 1st April, 12,800 on 1st April 24, and 12,700 on 20th October 2023. In this case, again it will become 1st April 2023, which is $12,500. The exchange rates of USD to RBI reference rate is given as follows. Since you are doing it on 1st April, it will become 71 rupees. It will become 71 rupees. You are required to calculate the undisclosed income. What will be the undisclosed income? In the first scenario, we will take 25,000 into 71. We will take 25,000 into 71. In the second scenario, we will take 12,500 into 71. Yes, so they have done the same thing. It is 25,000 and then where is it? 10,000 ka 12,500. 10,000 ka 12,500. They have multiplied that with 71 rupees and then they've got the numbers. Yeah. Next. Mr. Harshit has stayed in India for only 48 days during the previous year 23-24. He had acquired a house property located in country A in September 2013 for 18 lakhs. So in the current year, he has stayed only for 48 days, which means current year he is a non-resident. He acquired a property in 2013 for 80 lakhs when he was in from country A. Out of the investments of 80 lakhs, 55 lakhs was assessed to tax in total income of 13-14 and 12-13 when he was a resident in India. So they also clarified that he was a resident in India in that year, and out of that 80 lakhs, 55 lakhs was already taxed. The remaining income had not been taxed in any earlier years. The asset came to the notice of the AO in March 2024 when the property value was 120 lakhs. Same numbers we did. What is happening is earlier when it was 80 lakhs, today it became 120 lakhs. Out of the 80 lakhs, 55 lakhs got taxed, which means how much will not get taxed? You'll have to cross multiply. Number will come as 82.5. You'll remove 82.5, which means the taxable amount will become 37.5 lakhs. 37.5 lakhs. Yes. So 37.5 lakhs is what you're going to tax in the hands of Harshit for the current year. Yes, like I told you, those three things is what is most important from exam perspective. So please read those three things properly. Yes. Great. There is one other question which has come in the recent RTPs of May 2024. Please to go through that RTP of May 2024. There is one very beautiful question where they'll come and talk about the first scenario, the resident and the non-resident wala scenario. Talk about it very carefully. You will get a very beautiful question and a very good idea about that definition. So please to go through that RTP of May 2024 and you'll get a fair idea. Yes.